Okay. All right, great. And let's go ahead then and let's start to take a look at the modules that were left from chapter 1. My recollection for chapter 1 is that we still needed to complete module 3 and 4 dealing with revenue recognition. Is that correct? Is that on par with what you guys
Yes.
are? Okay, good. Thank you. Okay, good. So let's go ahead and let's start to take a look at this. And revenue recognition, the FASB and the International Accounting Standards Board, although IFRS is not part of the CPA exam, they did come out with a joint standard on revenue recognition, and that was in the codification, the US GAAP codification. Let me go ahead and put my machine into full screen mode. And some of you may be aware that that's in the Accounting Standards Codification, and it's in topic 606. Now, what they were doing at that time, this is maybe a couple, 3 years ago, trying to address new transactions that had come up, particularly in the case of organizations like Uber, who their business models to be more of an agent than the principal that's directly responsible for providing the service, those sort of things. So they felt a need to address those kinds of things. And so because of that, they went ahead and they issued a new revenue recognition standard that, for the most part, took certain things that we already know about revenue recognition and formally started putting some bright lines of guidance around those things. So when you look at this, it starts to sound more complicated, I believe, than it is. The more I look at this, the more I realize that these are things that we've been doing for a long, long time, and now we're putting some more formal wording around it. And I think the sense was that that was needed in the context of the changing economic setting in the U.S. with the apps being provided and that sort of thing. So that's where we're going with this. And so let me ask you a couple questions here at the very beginning. If I receive cash in advance of providing a service, can I recognize that service? I mean, that revenue, excuse me?
Not normally.
No. If I receive cash in advance, I don't know, I can't think of any situation where you can recognize revenue if you haven't provided the service. And what will happen? I'll either provide that service at a single point in time, which will allow me to recognize the revenue, or I will have to recognize that revenue over time as I provide that service, right? So we've known that for a long, long time. So what we're going to see in this 5-step approach that we're going to outline and then look at some specific examples, that's going to be our main task, is determining whether or not there is one or more service being provided in a contract, and then is that service being provided at a single point in time or over time. If I receive amounts in advance and I haven't earned them yet, I can't take the revenue. I debit, say, the cash. What should I credit if I haven't provided the service yet?
Unearned revenue?
Unearned revenue of some sort, a liability of some sort, right? Okay, so you all know this already. We're just going to put some formal lines around this and formal definitions, flashcard where the definitions get a little wonky on us, and we'll be in good shape to be able to answer any questions on the CPA exam for this. Okay, so let's first look at this 5-step process. And they say to recognize revenue, you have to determine, do I have a meeting of the mind with the customer? And there are no real questions that determine, is there a meeting of the minds? Usually the questions start out, hey, you're in this contract with a customer, right? Then we need to look to see, is there one or more performance obligations in the contract? For example, if all we're going to do is deliver some product to the client, then what? Then we would just have the one service obligation, whatever, which is to provide that product to the client. If it says, well, we're going to provide the product to the client, but then we're also going to provide some sort of technical support, then there'd be what? 2 performance obligations, and we'd have to determine, Is that going to be recognized over time or at a single point in time? We would have to determine the transaction price, and that's pretty much often given in the question. This is what you're charging for this service. But then if you have more than one performance obligation, you will have to separate that transaction price into the different performance obligations. And then you need to determine, should I recognize that revenue at a point in time, or should I recognize it over time? Okay, and you could have a situation where part of the transaction price you can recognize immediately, and another part you'd have to recognize over time. And that's about as complicated as this stuff gets, okay, or at least the transaction gets, okay? So I think it might be worthwhile for you to go ahead, flashcard these steps, just in case you get a question that asks you specifically about the steps. But I think what you're going to see that as we look at these transactions, these are pretty straightforward. So we're really going to take a example-driven approach as we go through this material here in the next couple of modules, okay? Now, as I've already stated, if you can't recognize the revenue for whatever reason, you haven't satisfied the performance obligation, then the amount that you get in, which is almost always cash, or at least some sort of contract asset of some sort, if that's the case, then you haven't recognized the revenue yet, then you have to credit a liability. That liability is often called unearned revenue. You know that liability is an unearned revenue. You've known that for a long time, right? So let's just go ahead and let's take a look at this example, okay? And they tell us that on March 1st, year one, they entered into a contract to transfer product to Kitty. Bulldog is going to transfer product to Kitty on September 1st, year one. Kitty will pay the full contract price of $15,000 to Bulldog by August 1st, and Bulldog transfers the property to Kitty, and the cost of the product totaled $9,000. And they're telling us the cost of product because we're going to have to account for our cost of goods sold in our inventory, okay? Now, when you sign the contract, even though you have a contract, there's no journal entry because neither party has performed on any part of the contract obligation. On October 1st, though, as they told us in the question, Kitty went ahead and did what? Kitty paid the full contract price on August 1st. And so when they pay, of course, we have to debit cash. And because we haven't performed on the contract yet, we won't until September, we take the liability, right? I think you all know that that's a liability. Forgive me if I'm over explaining the idea that unearned revenue is a liability. Guys, I do teach an introductory class, and I have to keep reminding them that unearned revenue is a liability. So that's a little bit in my DNA right now. But when that money comes in on October 1st, because I haven't performed on the contract yet, I debit cash, I credit the unearned revenue. And then when I go ahead and I perform on that contract, now the big takeaway here is I can go ahead and take the revenue, and of course I would debit the cost of goods sold and credit the inventory. Nothing earth-shattering there at all, right? Question? Okay, good. So I come over now and they tell us, well, then you have to figure out what are the performance obligations, okay? And it could be one performance obligation, or it could be what? More than one, okay? So let's just go ahead, and they tell us and I want you to just go ahead and go to the example. I could read through some of the things that they tell us here, but at the end of the day, it really becomes more of a reading comprehension issue. So let's take a look. Here they give us a single performance obligation. Here we have separately identifiable performance obligation, okay? So let's look at this. We got this Tanner company is building a multi-unit residential complex. They enter into a contract with a customer for a specific unit that is under construction. The goods and services to be provided in the contract include construction, piping, wiring, installation of equipment, and finishing. Now you look at all that, and I doubt that a contract for a condo unit would talk about the piping, the wiring, okay? And so this is a little bit of a kind of a silly example in many ways, and that a contract wouldn't really read this way, but obviously what they can't deliver the condo to you if there's no plumbing in the thing, okay? So they tell us here that although the goods and services provided by the contractor are capable and distinct, the goods and services cannot be separately identified from the promise. The contract will integrate the goods and service into the unit, so it's going to be considered a single performance obligation. So what you're really supposed to take from this example is not a very realistic example of a contract in a situation like this, as much as it would be, hey, if a contract calls out different specifications, but you can't really perform on the idea of giving a condo unit or giving a vehicle to somebody without all of those different things, then, you know, I'll give you the vehicle, including an engine. Well, okay, but I can't give you the vehicle without the engine. What's the point? And so at that point in time, that would be seen as a single performance obligation. Now, separately identifiable, and to me, probably more realistic of something that you'll see on the exam, because what they're going to want to see is, if I give you a fact pattern, can you call out the different performance obligations associated with that contract? And then, of course, we're going to have to do what? We're going to have to allocate the contract price to the different performance obligations. Another interesting accounting point. And then we're going to have to do what? Determine if we can recognize any of those performance obligations at a point in time, or will we recognize them over time? That's really all we're doing here with this whole discussion. Okay, so they tell us that we have a software developer introducing a contract to transfer software license, okay, perform installation, provide the software updates, and to give, and I'm just going to go back to green, provide technical support for 5 years. Okay, and that 5 years, I think you're thinking, well, that technical support, if it's a separate performance obligation, we're going to recognize that over time, right? So what happens? The developer sells the license, the installation, the updates, and the tech support separately. Boom, right there. You say, okay, well, thank you very much. They just gave me the different performance obligations. In fact, it almost seems silly to delay any further giving the solution here. Obviously, each one of those is a separate performance obligation. Okay, question. Okay, good. Let's take a look now. We have the transaction price, and we're going to have to look to see how we're going to deal with the transaction price. Now, a couple of things that I want you to flashcard, okay? And I want you to go ahead and create a flashcard. I'm just going to write what I want you to put on the flashcard here. What elements are to be considered? Okay, what elements are to be considered when determining transaction price? What elements, let me read that back to you because I know my writing is pretty hard to read. What elements are to be considered when determining transaction price? Okay, and there are 4 of them. One is there variable consideration? I'm going to come back and talk more about some of these in a minute. Is there significant financing? Is there non-cash consideration? Well, I don't know why that wouldn't be 3. Do 3. Okay. Is there non-cash consideration? And is there consideration that is payable to the customer? Okay, so I just want you to flashcard at a high level those 4 things that could be considered. Okay, and then let's go ahead and let's take a look in more detail at a couple of these. So let's talk about variable consideration. So the amount of variable consideration should be estimated by taking a range of possible amounts and using the expected value, which sums probability weighted amounts or most likely amount, whichever is assumed to be a better predictor. So if it says that the consideration could be this, it could be that, and it's 10% chance that it's this, 90% chance that it's that, you'd multiply whatever say it said 10,000, you multiply that by 10%. They say it could be as much as 40,000, you multiply that by 90%, take those two products, add them together, that's what you would use for the transaction price, okay? So go ahead, flashcard that. Significant financing, I should say, and if there's significant financing, then we must use the time value of money to adjust the transaction price, okay? Now, you take a look at that, and let's just look at the example down here, okay, where they're talking about time value of money. And they tell us that on January 1st, year 5, this company sold furniture to a customer for $4,000 with 3 years interest-free credit, okay? And I always laugh when they say interest-free for 3 years or whatever, you know, and I always think to myself, well, what would happen if you offered them to pay the amount up front in cash today? They'd say, oh, okay, we'll give you a cash discount, okay? So, you know, when they tell you it's interest-free, accountants just kind of chuckle to themselves when they tell you that, right? So what happened? The customer took delivery of the furniture that day, okay? And so there is $4,000 that is going to be payable in year 7. So we're going to go all of year 5, all of year 6, all of year 7 before we have to pay. And they tell us that the applicable discount rate here is 8%. Now, the way they came up with the discount rate, guys, is they're all of a sudden, you know, using, what do you call that, exponential nomenclature here and whatnot. And the way I look at this is I'm like, well, wait a minute. I would look to see what is the present value of $4,000 3 periods from now at 8%. And if you were to look that up on a present value table or do a calculation in Excel or something, the number for the present value factor would be 0.79383. Okay, so on the exam, you will likely have a tool available for a question like this. If you were doing it in a task-based simulation, where they'll let you look up the factor, or if it was a multiple choice question, they'd probably give you a table or a portion of a table where they would expect you to be able to look up the factor of present value of $1 at 8% for 3 years. And the intersection on that would be 0.79383. You take that and you multiply that by what? $4,000, okay? And that gives you a present value of $3,175.32. And so what happens? The amount of revenue that you recognize at the point where you're delivering the furniture to them is that $3,175. That's the transaction price. And this would just be a point in time piece of the transaction. So you would debit accounts receivable, $3,175, and credit revenue, $3,175. Now, what's going to happen? Then as you go through each year, well, that piece, the interest income part, is recognized over time. And so in the first year, the $3,175 times the interest rate on that 8% means you've earned interest at $254. Then using compound interest factors, right? You go ahead and you take that interest and add it onto the principal. 8% of that gives you the amount for year 6. And then you do the same thing for year 7. All of those would be recognized as interest revenue each year, debiting, and you could either debit interest receivable or accounts receivable there, so that that will total $4,000 by the time you have to go ahead and expect to receive the $4,000 from the customer. Question. Okay, if we have non-cash consideration, okay, then we'd have to figure out what is the fair value of that non-cash consideration at the inception of the contract. And if we are going to give consideration payable to a customer, any cash, credits, et cetera, that is payable to a customer is treated as a reduction of the transaction price. So if you're going to kick them back a rebate or something, that is going to be what? That is going to be considered a reduction of the transaction price. And I'll have you flashcard that one. Question. Okay, so I think you're getting the sense here, guys, even though we're putting a lot of, fancy, if you will, terminology around this, at the end of the day, this is stuff that we probably know for a long, long time, right? Okay, good. Now, once you have determined the transaction price, if there is more than one performance obligation, the transaction price should be allocated to each performance obligation based on the amount of consideration that would be expected to satisfy each unique obligation. We just did that in a way with the interest versus the amount that we're receiving for having delivered this furniture or whatever it was. But let's just go ahead and let's take a look at a couple of, really we're going to focus on an example, but let's just look at the standalone price. Okay, the price an entity would sell the promised goods or services to a customer on a standalone basis. Okay, and once that price is determined, each obligation within the contract, the total transaction price should be allocated in proportion to the standalone selling prices. Okay, so let's just go ahead and let's take a look at this example down here, guys, and I think you'll see things like this in your homework. And I don't know, I find these things, I guess I was, obviously, I always say, gee, I'm obviously an accountant. I don't know why I say that. I'm a CPA. I'm licensed to be an accountant. So why do I have to point that out? But anyway, we take a look and I find this a little bit kind of fun. Okay. So we have what? We have a $250 contract with a customer to transfer, and here come the performance obligations. We have the software license, installation, tech support, software license. So there's 3 performance obligations here. Okay, thank you. Okay, and we know that the contract price is what? $250. But we're going to have to figure out, how do we allocate that $250? Okay. Now they tell us that the license is usually sold for $160. The installation service generally costs our customers $20,000. The tech support runs $30,000 what? Per year. We know that we're going to have to take that $30,000, recognize that over time, as well as allocate this total $250 between the different performance obligations. Okay. Now they go ahead and they tell us that they want to see how should the software company recognize revenue, and we have 3 performance obligations. Now, this part, they kind of labeled it as though it was under solution, but this would be additional information you would need to solve this problem, because they tell us that the fair value of a contract like this is $270. Okay, so we use that $270, and then we go ahead and we allocate then the amounts that they gave us, which is the $160 for the installation, the $20,000 for the installation service. Well, I guess you could have got to the $270 without them giving you that additional information, because it's $30,000 per year. 30,000 per year times 90 brings you up to the total base here of $270. And then you simply go ahead and do what? Allocate those amounts to the 3 separate performance obligations. You can take those first 2 immediately. The tech support piece, the license for the revenue, and the license revenue and the service revenue for the installation, you can take immediately. The unearned service revenue is going to be that tech support, and you'll take that over 3 years. Now, in this example, they signed the contract on what, March 1st Okay, when you count months, guys, be careful. It is an easy mistake to make on the exam to say, well, March is the third month, so that means it's allocated over 9. But if it's what? If it's March 1st, and if you have to count on your fingers, go ahead. All of March, all of April, all of May, all of June, all of July, all of August, September, October, November, December, that's 10 months. If you got to count on your fingers to keep yourself honest on those questions, don't be embarrassed. Just do it. I always have to count myself because I always make the mistake that I see March and I automatically want to say, well, that's the third month, so that means it's 9 months. If it's the beginning of the month, you have to count that month, right? Okay, so they go ahead and they say, well, if we're talking about 83,333 over 3 years, which is 36 months, we'll take $2,314 or 23. Oh yeah, $2,314.80 per month times the 10 months. That means in year 1, we'll take 23,000. And then going forward, we'll be able to take the full 12 months as we go into year 2. And then year 3, I guess there'd only be what, so many months left on that contract. Now I'm getting myself stuck on year 3. I guess there'd be still 12 months. And then in year 4 of the contract, there'd be only the 4 months. Okay. Okay, question? Okay, good. Now, let's go ahead and let's take a look at the idea of revenue being satisfied over time. Okay. Now, when revenue is satisfied over time, we will need to meet these criteria, and you need to only meet one of these criteria in order to recognize something over time. Okay. We'll deal with a point in time. Remember, that's our 2 options, over time or a point in time. And we'll deal with a point in time here in a couple seconds. And guys, these are really kind of, common sense a little bit, if there is such a thing as common sense. But I'm still going to ask you to flashcard these just in case, somebody asks you specifically what we mean by satisfied over time. But you could also read a question's fact pattern and kind of get a feel for it. But the entity's performance creates or enhances an asset that the customer controls. The best thing I can think of off the top of my head is, let's say you hire somebody to do the landscaping in your backyard. Do you control the asset? Do you control the asset, your backyard?
Yes.
Yeah. You control your backyard. So the landscaper could probably recognize that revenue as they progress towards finishing up your backyard, right? Okay, good. The customer receives benefits of the entity's performance as the entity performs the service contract, well, such as cleaning service. Well, that's a no-brainer. I mean, you've known that for a long time, right? As the service is provided, take the revenue. Okay, that's over time, right? The entity's performance does not create an asset with alternative use to the entity, and the entity has an enforceable right to receive payments for performance completed to date. Now, look, I could point to the backyard thing again, okay, because they can't really have an alternative use other than your backyard. But let's use a different example. Let's say someone's building a custom yacht for you. And you've said, I want the yacht to have, this kind of kitchen and that kind of, inboard, outboard, and lights and fancy and dancing areas and so on and so forth. Well, in that case, then they are basically performing, creates an asset that doesn't have an alternative use other than for you to take that yacht. Okay, people that afford yachts are very picky. They want it to be their way. Or if the contract specifically says they can't direct this to somebody else, then that's going to be considered something that they can recognize over time as they are performing on that. Okay. Now, notice they tell us that in order to recognize revenue, the entity must be able to reasonably measure progress towards completion. And you can use output method or input method. Okay. And so you take a look, if it's output method, it's saying, hey, how far along have I gone? What have I created towards the promise to deliver those goods or services? If it's input method, I'll recognize revenue as I go ahead and start to spend money such as cost incurred, et cetera. We're going to look at completed contract method, percentage of completion method, accounting for construction contracts here in a little while. And that's an input method because we look at where our costs have been incurred to date, and that allows us to determine how much revenue we're going to take. Okay. Now, when we look, we can have performance satisfied over time. And okay, I guess we can look at this. I don't find this particularly interesting, but I thought they had something better than this. But let's go ahead and take a look at this. This is like, duh, but that's all right. Health club enters into a contract with the customer for 1 year of unlimited health club access for $75 per month. The health club determined that the customer simultaneously receives and consumes the benefits of the club's performance. So the contract is a performance obligation over time. And so we would go ahead and we would take the revenue at what? $75 per month. So I don't find that particularly enlightening. Hello, you didn't need to graduate college. You didn't need 24 units of accounting to be able to answer that question. Okay, but let's go ahead. And I think what's more interesting is satisfied at a point in time, or maybe not more interesting because satisfied over time. We saw what some of the example criteria were here. And I think that question, the example we just looked at, was an example of that second bullet. Okay, but let's come back here and let's take a look at this question here, satisfied at a point in time. Okay, and so control would require the following. So let's just look, the performance obligation not satisfied over time and is satisfied at a point in time, do you think? And revenue would be recognized at the point in time when the customer obtained control of the asset. Now, I'm kind of being facetious there when I say, do you think? But back up and store in your mind, those are the options. It's either over time or what? At a single point in time. And it would be a single point in time generally require the following. And guys, when it says generally require the following, that tends to mean that what? That it is the preponderance of the information that you see that's telling you whether or not you could recognize that at a point in time. Okay, so the entity has a right to payment and the customer has an obligation to pay for the asset. The customer has legal title to the asset. The entity has transferred physical possession of the asset. And that's probably what? That's probably the big one. I mean, once you have received the asset, or you delivered the asset, the inventory, whatever it is, you're probably going to be able to take that revenue. The customer has significant rewards and risks of ownership, and the customer has accepted the asset. Okay, so go ahead. I guess you can flashcard these. Again, I find this stuff pretty, pretty basic, but let's go ahead and let's take a look at this example. Okay, and let's see what happens when it is overtime. And what happens, Tanner is building a multi-unit residential complex. The entity enters into contract with the customer for a specific unit that is under contract, and the contract has the following terms. The customer pays a non-refundable security deposit upon entering the contract. The customer agrees to make progressive payments during construction. Okay. If you're buying, a house in a tract that isn't a custom built house, you don't make progressive payments. You wait until everything is done, the house is ready to take it over, and that's when the transaction and all the funds get transferred and everything. If it's a custom house you've contracted with somebody to build that house, then what? They're probably going to expect payments over time. So when you think of this obligation satisfied over time, think of more of a custom type of an item as opposed to just sort of a unit where you don't own that until it is completed, like a tract home. Usually when it's a custom home, what happens? You've bought the lot from maybe somebody else, and then you have somebody else come and build the house on top of that. Well, look, if you don't perform, they're not going to come and tear up the house and take it. They're going to sue you for what? For whatever they performed up until that time. So that would be something where they could recognize the revenue over time, right? So that's what we're saying here. If the customer fails to make progressive payments, the entity has a right to all the consideration in the contract if it completes the unit. And the terms of the contract prevent the entity from directing the unit to another customer. If you see that in a question, that is probably one of the more telling things here that tells you what that is going to be recognized over time. Okay. Now you come over and so it's satisfied over time, and I'm kind of given the reasons there. I don't need to reread the reasoning that they give here, but let's take a look at satisfied in a point in time, okay? And now it's a multi-unit residential complex. The entity enters into a contract. The contract has the following terms. The customer pays a deposit that is refundable if the entity fails to complete the unit in accordance with the contract. Remainder of the purchase price is due on the completion of the unit. And that's the example I'm giving you with the tract home. That's how it works. You pick a tract home, you say, this is the one I want. Even though you may specify certain things that you want, you don't own that thing until they hand the keys to you, right? Okay. And so the purchase price is then due on the completion of that. If the customer defaults on the contract, the entity only has the right to retain the deposit. They can't force you to buy that house. You might have to forfeit the deposit. And in the state of California, they can only make you forfeit the deposit if they can't sell the house that you agreed to on a price to somebody else. And that's rarely the case, usually because of the way, houses have gone like hotcakes, they can sell that to somebody else and they have to give you the deposit back. Okay, so this one is what's satisfied in a point in time. The other thing that would indicate that it would be at a point in time is if they had said they can direct this property to somebody else if you don't take it, and that's often the case of a tract home. Okay, so I think what's useful in your mind's eye here is you look at these over time, point in time, just sort of imagine, hey, I'm doing a custom house, I have this lot, I buy the lot from somebody else, I tell the contractor exactly what I want there, I can't take the lot away, the house is on the lot, so that's probably what, over time as they construct that house for me. Tract home, you don't own any of that, the land, the house, anything until they're done and they turn the keys over to you and you provide the consideration at that time. Okay. Okay, good. Let's go ahead then and let's take a look at presentation. And guys, this is a little annoying. FASB's a bunch of nerds. Okay, there's 7 nerds, that need to justify their existence. And sometimes I look at some of this stuff and I'm like, boy, they must have really been bored the day they came up with this stuff. Okay, they must have had nothing better to do. Okay, I met with the FASB when I was working for the Government Accountability Office. This is years ago. And it was during the time when the O.J. Simpson verdict was going to be released. It was going to be released at 1 o'clock Eastern time during the time that we were in Connecticut meeting with the FASB. And so we're supposed to meet them at 1 o'clock Eastern, but then it had been announced that the verdict was going to be released at 1 o'clock Eastern. So we get a call that morning from one of the program managers at FASB, says the board would like to postpone the meeting until 1:30. And we're like, okay, what's going on? They say, well, they want to watch the verdict of the O.J. Simpson trial. So If they have something better to do, they sometimes do that rather than sit around and come up with some of this nonsense. Okay, but it is what it is. Hey, we don't tell them, they tell us, right? And so when they come over and they say, we can either have a contract asset or a liability, means we're going to show something on the balance sheet. It's either going to be an asset or a liability. We'll look at what generates an asset versus a liability in a second. Should be presented in the statement of financial position. That's the balance sheet, when either party has performed in a contract. Okay, so it's either going to be what? An asset or a liability. Let's understand what happens when it's an asset. Okay, the asset reflects the entity's right to consideration in exchange for goods or services that the entity has transferred to the customer. Essentially, the entity has performed prior to the customer paying to the prior to the payment due date, and the condition associated with these rights are something other than the passage of time. Okay, now when you read all that, you're like, well, didn't we call that accounts receivable? Isn't that like an accounts receivable? And they're saying, well, yeah, but we're FASB and we're bored and we don't have anything better to do. So no, we're going to call it contract asset unless all that's being waited for is the passage of time. Then you can call it a receivable. Okay, and you look at that and you're like, I don't know, I picture that eye rolling emoji. Oh, brother. Okay, but let's just go ahead and let's look at example 9. Okay, and you can kind of put that there because I'm sure you'll read that later and say, what is this? Okay, example 9, number 9, which is on the next page. And you come over and let's just first go to that example 9, and you're going to roll your eyes too after you look at this. Okay, and I guess there are deals like this, and FASB felt compelled that they had to put something fancy around this kind of stuff. So on January 1st, Anderson Company enters into a contract with Tanner for the sale of 2 excavators, $350,000 each. The contract requires one excavator to be delivered on February 1st, and states that the payment of the delivery of the first excavator is conditional on the delivery of the second excavator. The second excavator is not delivered until June 1st. So when they give up the first excavator, say that 10 times fast, they have that contract asset and they can take the revenue because they have delivered the first excavator. So they performed on that. But they can't say receivable because it's not just predicated on the passage of time, it's predicated on the delivery of that second excavator. Okay, then what? Then they go ahead and on June 1st, they go ahead and they deliver the second excavator. Now they record the whole amount as receivable because now all they're waiting for is what? The payment, the passage of time here. Of course, they credit the contract asset because they're now calling that out as a receivable, and they can take the revenue for the second excavator. And of course, when they get paid, they'll debit cash and they'll credit the receivable, right, for the 700,000. I guess I'll put in the amount. That's receivable. That looks like revenue. I meant to credit receivable. Question.
This is essentially like a placeholder for the receivable until that obligation that's something other than passage of time has happened.
Yeah, that's a good way to look at it. I'd call it a nerdy placeholder.
Okay, thanks.
Is it really that important that we call it out as a contract asset versus a receivable? I guess. I guess technically what they're saying to us here is, well, what if something happens and you can't deliver the second excavator? What are you going to do? Well, if you can't deliver the second excavator, I guess they're going to have to give you back the first one. You'd be crazy if you didn't put that in the deal because you never got paid for the first one, right? So the deal would have to be that they're going to give the first excavator back to you if you can't give them the second. And if that's the case, you would do what? You would debit the revenue and credit the contract asset at that point in time, right? And so I guess they felt compelled to give an accounting around that and decided to call it a contract asset instead of a receivable. because there
Then,
is
Professor, the
some
contract.
contractual obligation there.
So the contract asset can be long-term or current asset, depending on the where it is attached to.
Yeah, I reckon. Yeah, I reckon that's true. If it's going to take you a couple of years to do that, I would think, to deliver that second thing, whatever it is, then I would think, yeah, Roy, that would need to be a long term because it's, falling past our year of thumb of 1 year. Although if the operating cycle of the company, if it takes you 2 years to build an excavator, maybe it could be current, right?
Yeah.
So can I ask the question, why would they be recognizing the revenue if it's depending to provide the second excavator?
Because, it really is getting into the matching principle, because any costs associated with developing that first excavator would have been incurred by February 1st, right? And if, let's say, we had a fiscal year end that ended March 30th, you would have you'd have an improper matching of revenue and expenses because you would have incurred certain administrative expenses and whatnot at that point in time. Yet, you delivered that excavator, yet you're not taking any of the revenue, right? So you'd have a problem with the matching.
I thought the matching was, yeah, it makes sense.
Yeah. I mean, they didn't show here them taking cost of goods, so, debiting cost of goods sold and creating the inventory. They kind of ignored that, but that would have happened at February 1st when you give that first excavator. But, if you just ignored the whole thing and didn't record any of that, which would be weird because you don't have control of that first excavator anyway. So I think you're going to have to take it out of inventory. You're starting to see the matching problem. And so that's, I think, why they're asking you to go ahead and take the revenue, and rather than call it receivable, like Kylie said, it's a placeholder for receivable. We call it contract asset.
Or maybe because when you receive the first excavator, you have control over it and you can use it anyway already, probably. Maybe.
Yeah. Well, looking at it from the standpoint of the person that got it, and going back to our revenue recognition, they've taken control of asset. They have all the risks and rewards of that asset, right? If they drive it off a cliff, it ain't our fault. It's not the seller's fault. It's they're out. We're going to go, look what happened to your excavator. So we can take the revenue, right? Okay, good. Now you come over, and we also said it could be a contract liability. So I just wanted to come back to the contract liability. Must be booked when an entity has an obligation to transfer goods or services to a customer. In this situation, the entity has already received consideration from the customer and owes consideration, or the customer owes consideration, and it is unconditional. Okay, guys, I mean, I think you're getting the sense of the annoying language that's being put around, excuse my French, shit that we already know. We know that if someone pays me in advance and I haven't performed, that's a liability. We know that. Now they're just putting words like what? Contract liability on that, as opposed to the words unearned revenue. Okay, so we take a look, and by the way, the exam is not going to say, was this an unearned revenue or is it a contract liability? No. Contract liability is a fancy word for unearned revenue. Okay, now in the case of the contract asset, yeah, they've given us something very specific there, that if it's just, waiting for them to pay on something you delivered everything on, then yeah, that should be called a receivable versus an asset. Okay, but you come over and you look at this one, and it's a non-cancelable contract to sell an excavator for $350,000. The excavator will be delivered to Tanner on April 1st. The contract requires Tanner to pay $350,000 in advance. Okay, that's going to mean I'm going to have some unearned liability on February 1st, and Tanner makes the payment on March 1st. Okay, so let's go ahead and let's take a look at this. on February 1st, notice guys, January 1st, nothing happens, right? It's when what we start to now have a requirement that they're going to have to pay me. And it's what they were supposed to pay me on February 1st. They did not pay me yet. So I go ahead and I recognize a receivable and I credit the contract liability. Then on March 1st, okay, they were a little late. They finally get around to paying me. And I simply reclass the what? The receivable as cash. And I still have that contract liability until such time that I do what? That I go ahead and I deliver the excavator. I perform on that contract, debit the contract liability, and credit the revenue. Contract liability, guys, fancy word for unearned revenue, okay? In fact, let's just go ahead and let's take a look at, question 2 first, okay, for our class question tonight. We'll come back to that first one, but I just want to take a look at question 2. And I think you're going to sort of sit there and say, all that just to, get to something that I could easily answer like this one. Okay. Now, let me give you one quick tip though, before I put up the poll. On the CPA exam, and I even see this in, introductory class exams, and I always tell my introductory students, don't fall into the trap, and I'm going to remind you of this here. CPA questions, accounting questions, textbook questions and stuff, like to ask you part of a journal entry. They ask you the debit, they ask you the credit. Is that your training? Is your training to sit here and think, oh, well, let me just think of the debit of this transaction? Or is your training to do what? Understand the debit, the credit, maybe understand even the credit first so that you can back into the debit? Isn't that how you figure things out in accounting? So when you see a question like this one asking you for one side of a journal entry, don't fall in that trap. Make the whole journal entry and probably go ahead where there's one like this one that gives you multiple steps to a transaction and then asks you ultimately what should happen on a specific date. Make the journal entries for each one of the dates that's called out so that then you can compare it to the one for whatever date they're asking, and that'll allow you to select the right answer. Okay, so let's go ahead with that approach in mind, and let's take a look at this question. Okay, looks like most of us have had a chance to answer this one, so I'm going to go ahead and end the poll. And are you seeing the results? Or are you seeing a bunch of zeros?
We see the results.
Okay, so I'm not sure there's something odd going on here, but anyway, maybe you were seeing the results as they were coming in. Was that happening? Something weird's going on, but anyway, you can see that the correct answer is D, and most of us got it right. Okay, now let me go ahead and I don't know why my computer is acting up here on my viewing screen. Okay, but the results are off the screen now, right?
Yes.
Yes.
Yeah, okay. Something weird, for some reason, I log in, that's the reason you see me twice. I log in as a participant, and it was showing me the results on my participant screen for some reason, which is, it's supposed to show them to me on my tablet here. Anyway, okay, so let's go ahead, and we say that on April 15th, year 3, Land & Company signed a contract that entailed providing a piece of scientific equipment for $215,000 to Jacob Inc. Now look, at April 15th, nobody has done anything yet on this contract, right? Delivery is expected August 31st, year 3. Per the term of the contract, Jacobs will pay London for the full amount on July 31st, year 3. Landon's cost to produce the equipment is $175,000. Assuming delivery occurs when expected on August 31st, what should be the debits, credits involved? And then they look, and they only give me half of the journal entry here, right, from my choices. So the way I would approach this is I'd say, well, nothing happens on April 15th, but on 7/31, what happened? They did pay cash of what, 215? And we would have credited what? And we could credit unearned revenue, which is a fancy word of saying what? Fancy way of saying what? Contract liability. But I have to credit unearned revenue because they didn't give me contract liability as a choice here in these. So I'm going to credit unearned revenue. Okay. Then what? Then on 8/31, I go ahead and I actually deliver per the contract. So at that point in time, can I take the revenue if I've delivered on the contract? I'll debit unearned revenue 215. I'll credit what? Revenue.
Sales.
Okay, sales revenue, whatever. I'll credit revenue for 215. Good. And then I'm going to go ahead and do what? Just to complete the thought, debit cost of goods sold for 175,000 and credit the inventory, which was the cost of that thing that I'm providing them, 175,000. Okay, so now I look and let's go through. We know the answer is D, but let's go through the choices to see how we understand it. Would we credit cash for 215? I mean, that's nonsense. That's way out. Do you debit inventory on August 31st? No, we did what? We credited inventory. Do you credit cost of goods sold? No, we saw that we what? Debited cost of goods sold. We did do what? Debit the unearned revenue, which just about everybody got that. Question? Okay, good. Let's go back then and let's look at question 1. And what I'm going to do is I'm going to X that out and see if that helps my problem. It's something that, don't worry about that, guys. It's just, never mind the man behind the curtain on that one. And let me go ahead and put your poll back up. Every time they do an upgrade to Zoom, they screw something up. Okay, looks like most of us have had a chance to answer this, so I'm going to go ahead and end the poll here. Okay, and most of us got this right. This is something that is going to be recognized over time as you provide the service. And so when you take a look at this one now, okay, most of us got it right, but as you take a look at this one now, they say, well, you know, you could pay $540 in advance. And then as they provide the service each month, that will basically cover each monthly charge, that $540. So it'd be what, $540, you debit cash for $540, it's unearned revenue of $540, right? And then as you provide the service each month, 540 divided by 12 would give you what, $45 per month that you could go ahead and debit unearned for 45 and credit revenue for 45, right? And that's the way a deal like that works. This idea that if there's problems in between, you'll have to go and make an additional visit at no additional charge, but you're still providing that service as you go along. So it's not saying that it's predicated on results. It's predicated on what? On the actual performance on the contract. And so as you perform, you can take the revenue.
Professor, I'm just wondering if a company had a policy to just recognize that all at the end of the year, just to simplify sort of the transactional, you know, the journaling, would that be off? Would they, you know, face any kind of scrutiny being that conservative about it?
Yes, considering if it's material, because I mean, you're saying that they're being conservative by not recognizing the revenue until the year end. And I submit that that could be a earnings manipulation. In other words, they're thinking to themselves, well, look, we don't need as much revenue now. We want more revenue in the future, right? So what do? They wait to take revenue until whenever, you know, when they decide from a conservative standpoint, it's time to take the revenue. They could be managing their profits, right?
Yes.
You know, so, you know, we would want them to recognize revenue. You know, for example, what if they sign this contract? What if they sign this contract, just to try to give an example, because it's a little bit tougher. But let's say they sign the contract on December. Let's see. They sign the contract on February 1st, not quite your question. And then they're going to wait until the contract is over, till the 12 months is over to take that contract. Well, even though most of the service and the work was done in year one, right, from February to December, if they wait till the contract's over and they don't take that till year two, we've got a horrible matching, don't we? And it could be that the entity is thinking, well, you know, our profits are strong enough now, but we're worried that our profits will not be strong in the future. So we'd like to throw that revenue into the next year, right? That would not be okay. Now, if you're telling me that the contracts pretty much are the same year to year, and it doesn't make a material difference to do it that way, then yeah, I guess from a simplicity standpoint, that would be okay. But if we have varying contracts as we go from year to year, and the difference of doing it the way you were sort of asking about versus the way the question is saying you would do it, and that amount was material, that would be a problem, yes.
So that wouldn't be a compliance to accrual basis of accounting, which is GAAP requirement, right?
Well, I'd be careful about saying that it's not accrual, because accrual says, I guess, says that you take the revenue when you provide the service, not when you receive the money. This is almost the
The
opposite,
opposite.
that
Yeah.
that you've received the money and you're still not taking it, and you perform the service and you're still not taking the revenue. I don't know what you call that.
Right.
Eric, do you have something else?
I had one more point. So is this essentially saying that this should be taken monthly or as different services are performed?
It should be taken as the service is performed. Revenue is taken as the service is performed.
Okay.
And they're telling us here that they provided monthly service. That's why I divided it by 12. They say it's monthly service. Well, I guess they didn't say monthly service, but I'm assuming it's monthly because they said they could pay monthly. I mean, I assume in between visits, I assume these guys are coming once a month. Isn't that usually when pest controls come? Okay, if you're going to come every other month, then this would be divided by 6, right? But they didn't ask us for numbers. It just said simply evenly over the contract year as the services performed, whatever it is, right? If it was bi-monthly, then I should divide this by 6, right? For 1 year's worth. I mean, it just depends, guys, on when I'm going to generate my financial statements, right? At that time, I have to figure out what service have I performed, what have I earned. That's the revenue I'm going to take, right?
So you have to account there during your month and closing process where you have to determine whether the service has been performed or not.
Look, if you take away financial statements, we don't have to do any of this. We can all go home and relax. If you don't prepare financial statements, who cares? Okay, but since we're assuming here that an entity is going to prepare financial statements, and we're going to want those financial statements whenever they're prepared, monthly, semi-annually, quarterly, yearly, whenever it is that they're going to generate a set of financial statements, which many companies do it monthly, they got to get busy and figure out how much revenue they've earned, right? And this one, I just assumed each month.
Especially for the listed companies.
Well, I mean, if you're a public company, you have we're going to talk a little bit more about this potentially tonight when we get into chapter 2. They have to file a 10Q, the quarterly, Q is quarterly. When they file that 10Q, that's quarterly statements. And a company would be somewhat irresponsible if they waited till, the 3rd month of the quarter to start doing stuff like this. So what companies do is they do that monthly and they close monthly so that they're not scrambling around trying to figure out everything that happened for the other 3 months. Even non-public companies that maybe only issue statement at year end will probably have a monthly close because they don't want to get into the business of waiting, till the end of the year. Oh, now we got to do all this year end stuff, where they could have sat there, and if they did this monthly preparation of financial statements, then it's simply an accumulation of the 12 months, isn't it? Okay. So again, you need to look at what is the date that they're asking me to report. That's the date that I will go ahead and make these adjustments that we're talking about. By the way, I noticed that, these questions keep saying under US GAAP. Let me reconfirm with you that IFRS, International Accounting Standards, are not tested on the CPA exam. Everything on the CPA exam is US GAAP. So anything they'd be asking you is US GAAP. Okay. Question? We already did that one.
Okay, can you show, before we get to that next module, can you show that page where you have the different revenue recognition criteria? Entity performance creates and enhances the asset.
Okay, do you mind if I ask you why you want me to show that?
Because you said there was a flashcard there, and I didn't get that one.
Okay, I'm not sure what,
The one,
like at the very
enhanced-
beginning of module 3 here.
I think it's after
You mean this
example
part?
5. I think we saw example 5. Maybe it's after example 5.
Example 5. Now I'm in example 9. I'm not used to being asked to be a book disc jockey here.
That I think. Oh,
This is example 5, so I'm still having trouble what you're asking me to do here. You mean this? I don't know what you want.
I think there were 3 portions where it was saying you need to meet this criteria
Oh,
to
okay.
recognize.
I see. You mean what elements? This one?
Yeah.
Okay. For determining transaction price? That one?
Yeah.
Okay. Okay, well, I'll tell you what, I'll leave that up on the screen. Why don't we go ahead and take the break and we will reconvene at 6:30, okay?
Thank you.
Okay, guys, we'll go ahead and take the break and I'll leave that up during the break. And
We're gonna have like 2 or 3 minutes after the session later.
Yes,
Just a, yeah, private and
sure, no problem. Yep. Mhm. Okay, guys, I'm going to pause the recording. Someone remind me to start it again and come back. Okay, so we got this next section. Some really kind of nit points here. The big part here for module 4 will be accounting for construction contracts under completed contract and under percentage of completion. So we'll get to that here in a couple seconds, but let's pick up a couple of these smaller areas here. Incremental cost of obtaining a contract. Okay, and the question is the cost of obtaining a contract going to be an expense or is it going to be an asset? If that cost is an asset, then of course we will go ahead and amortize that asset as we earn the revenue on that contract. Again, it could be over time, or we could recognize the amortization of that asset at the point in time that we actually recognize the revenue from the contract. Okay, so the incremental costs of obtaining a contract are those that would have been incurred had the contract not been obtained. Those would be expense, and we would recognize as an asset and amortize if the entity expects that it will recover the cost. Okay. That'll be how you recognize the asset. Nobody's winning any Pulitzer Prizes for the way they wrote that. And an entity will recognize an expense if the cost would have been incurred regardless of the contract. In English, what we're saying here is what? If you would have incurred the cost regardless of getting the contract, expense it. If the cost was incurred because you obtained the contract, then treat it as an asset and amortize it. Let's just look at the example and understand what you're talking about here. So a software developer, but go ahead and flashcard that requirement, those requirements. A software developer enters into a contract with a customer to transfer a software license, perform installation, provide software updates and tech support for 3 years in exchange for $240,000. In order to win the contract, the developer incurred the following costs. And let's look at this and see if we think it's an asset or something that should be expensed. So how about legal fees for drawing up the contract? You think asset or expense?
Expense.
Asset.
Huh?
Expense?
Asset.
Well, would you have to draw up a contract if you didn't win the contract?
No,
Would you have to drop the contract if you didn't win it, if the person didn't agree to contract with you? Would you have to write the contract if the person didn't agree to write to the contract?
no,
No. So that's what? That's an asset. How about travel cost to deliver the proposal? If you incur
Think
travel
expense.
costs to deliver the proposal, does the person have to sign the contract?
no,
No, this is just proposal, right?
Yeah, the proposal, it's an expense. Okay, I mean, the person may say, well, hey, guess what? We're not going to do this deal. Enjoy Kansas City, whatever. Okay. Commissions to sales employee. Do you have to pay commission if the person doesn't sign the contract? Guys, are you back with me now? Do you have to pay the commissions if the person doesn't sign the contract?
No.
So that's an asset. Good. Okay. Okay. And that's what they tell us down here in the answer. The travel cost, yeah, that should be expense. The other two are an asset. And then we would amortize what the 22,000 here. We would amortize that, and we would wait. Since it's a 3-year contract, I guess we'd amortize that over 3 years, right? If it was a situation where we have a point in time that's going to occur, say in the next period as to when we'll deliver that, then we'll take that expense. Those assets will expense them at that time. Okay. Okay, good. Cost to fulfill a contract. Okay. And they tell us that the costs are incurred to fulfill a contract that are not within the scope of another standard will be recognized as an asset if they meet, and when I see the word, the phrase, whatever, all the following criteria, the next word out of my mouth is what? Flashcard. Okay. So if the costs relate directly to the contract, such as materials, labor, etc., they generate or enhance the resources of the entity, and they are expected to be recovered. And you start to look at this and what? The relate directly is kind of a no-brainer, but they generate or enhance the resources of the entity. They are expected to be recovered. Does that sound like future economic benefit to you? Yeah. Is that the definition of an asset? Yeah. Okay. So take that as an asset. Costs to be expensed includes selling, general and administrative costs, wasted labor, etc. Things that we are typically used to what? Expensing in a period, but you can go ahead and flashcard that in case you need a reminder on that. Okay. Okay, good. We don't need to get into that. That's basically going to repeat that criteria for us. I think we got a flashcard on that. So principal versus an agent. What's going on here? Let's say you're going to buy a shirt from Nordstrom. Do you think Nordstrom is a principal or an agent? Let's look, before you answer, let's look at the definition. The entity controls the good or service before it is transferred to the customer. When this is the case, the revenue is equal to the gross consideration the entity expects to receive. So go back and flashcard that definition. But if you are buying a shirt or shorts from Nordstrom, okay, do you think Nordstrom would be the principal?
Principal.
They're the principal, right? You go in, you see the stuff, they have it there. They ain't gonna let you walk out without paying for it. Okay. So what happens? Let's say, and I don't know that you can find a shirt at Nordstrom for $10, but let's say the shirt costs $10. You would have what? Sales of $10. And if the shirt costs Nordstrom what? Say $8, then their what? Gross profit is $2, right? Okay. Now, if the entity simply arranges for another party to provide the good or service to the customer, then in this case, the revenue recognized is equal to the fee or commission for performing the agent function. Does that sound like anything you maybe have used recently? Anybody ever use this company, Uber? Okay, what happens? Uber is not the one providing the service. They arrange for a driver to come and find you through their platform, don't they? Okay, so let's say that Uber charges you $2 to arrange that. Okay, so for Uber, what happens? There, the sales is $2. The cost of goods sold is what? 0. They had no cost associated with that. They may have selling and administrative expenses, but they don't have a cost of goods sold because they didn't provide you anything. The what? The gross profit in that case then is how much? $2. Now, which business model do you prefer?
Agent?
Uber.
Agent looks better because you got 100% gross profit on this thing, don't you? Okay, not bad. Okay, now indicators that an entity is an agent. Let's flashcard those. Okay, and we say that what? Another party is primarily responsible for filling the contract, the driver. The entity does not have inventory risk. They're just arranging for you to get this. The entity does not have the discretion in establishing prices for the other party's good or service. You know, that doesn't necessarily fit with the Uber model because I think they do have some involvement in the price. But since this thing said indicators, it's not all, well, then it doesn't have to be all of these. Certainly, Uber would have met the first two very well, right? Okay.
Would an auction house be an example?
I have no idea.
Okay.
I just gave you an example. I don't know. What is an auction house? I don't know.
Like Christie's?
Who?
Like Christie's, you go buy a expensive piece of jewelry or furniture that some rich person wants to auction off?
I don't
Get
know.
out of the house?
I'm not
I
sure.
think the Airbnb is a good example.
I
Okay.
just gave you an example. If you want to ask me a question about my example. Okay, let's go ahead and let's take a look at repurchase agreements. Okay, and repurchase agreements, you know, this is again another one of those things that you're like, really, FASB, you had nothing better to think about here as to how to handle repurchase agreement. Okay, but let's go ahead, and I don't even anticipate the exam asking you this, but I want to avoid you some frustration when you're going ahead and you're looking at your homework and they give you Becker written questions dealing with this, and you're like, what's going on here? So I want to give you some sense as to what's going on, but I think we're kind of over the rainbow in terms of complexity and what I could see them asking you on the exam. Okay, but let's go ahead and we say a repurchase agreement is a contract by which an entity sells an asset and also promises or has the option to repurchase the asset. Okay, now the three main forms of repurchase agreements include an entity's obligation to purchase the asset, which is seen as a forward. In other words, the buyer can force the seller to rebuy that. Okay, that's what we mean by an obligation. Okay, obligation means it's a forward. The entity has the right to repurchase the asset. Okay, and if that's the case, we're going to call that a call option. So I can repurchase it if I want to, or the entity's obligation to repurchase at the customer's request, meaning now that the customer can, and we call that a put, the customer can request me to repurchase that. Okay, they call that a put option. Now, if it's a forward or a call, meaning what? I either have the option or I'm obligated to repurchase that. Okay, and the entity's account for the contract would be based on whether it must or can call the repurchase, the asset, for either less than the original selling price. If it's less than the original selling price, it will be a lease, and we cover leases in Chapter 5. Okay. If it is equal or more than the original price, we think of that as a financing agreement. So flashcard that. Now, think about that. If somebody can make me repurchase something that I sold to them for more or equal to the original selling price, I'm essentially borrowing money from them. I'm giving them the property, they're giving me the money, but they can make me give the money back. Well, if somebody can make you give money back to them, that's what? That's a liability, that's borrowing. Okay, so let's go ahead and take a look. If the contract is a financing agreement, the entity will recognize the asset, recognize a financial liability for the consideration received, and recognize interest expense as the difference between the amount of the consideration received from the customer and the amount of consideration to be paid by the customer. Okay, so go ahead, flashcard that, but let's look at this example. Okay, and again, guys, I'm going through this with you just to give you a context as to how to kind of look at this stuff. It starts to get into way too complex things, I think, even for the CPA exam. Okay, but let's just go ahead and we say on January 1st, Anderson Company enters a new contract for the sale of an excavator for $350,000. The contract includes the call option. Okay, I have the right to repurchase for $385,000. That's more than the $350,000, right? Tenor pays the entity $350,000 on January 1st. On December 31st, the option lapses unexercised. So when Anderson gets the $350,000, they can't take revenue because they could potentially what? Give that money back and repurchase the asset for more, the $385,000, for more than the $350,000. Give money back plus another $35,000. So then what? During the year, they would go ahead and recognize interest expense, credit the liability for $35,000, and then when they finally, the option lapses, they go ahead and debit the financial liability, credit the revenue, or if they exercise the revenue, they would have to do what? They would have to go ahead and credit the cash for this financial liability, because essentially they're buying that thing back. Okay, now if it is a put option means that what? The entity has an obligation to purchase the asset at the customer's request, and if it's for less than the original price, we will treat it as a lease if the customer has a significant economic incentive to exercise the right. That is going to be Chapter 5. Okay, but I want you to flashcard how to handle that. But the actual accounting will be when we count it for leases in Chapter 5. A sale with the right to return if the customer does not have a significant incentive to exercise the right. And we're going to see how to account for sale returns here in a couple of minutes. But that's how you would treat it, the way we're going to see in a little while, if the customer does not have a significant economic incentive to exercise the right, and it's for less than the original selling price. Now, if it's for more than the original selling price, greater than or equal to, if it's greater than or equal to, it's going to be a financing agreement if the repurchase price is more and the expected value of the asset, which is the same thing we said a minute ago when we were talking about a forward or call option. A sale with right to return, which we've already said, and all the reason they're saying this here again, they're repeating what they said up here, a sale with right to return, that's the same, except now they had to add what? They had to add that if it is equal, or here we were just saying if it is less. Up here we just said if it was less, then now there's less than. Now they're saying if it's less or equal, then you're going to go ahead and we already said that up there. Okay. Okay. Let's take a look at bill and hold arrangements, okay? Now, with bill and hold arrangements, basically what's happening here is we're holding something that we have sold as an accommodation for the customer, okay? So the customer could have taken control of that asset. We performed on the contract. We'll be able to take the revenue if we're just holding that for their for an accommodation. Okay. Now there must be we have to meet all of these criteria, which I want you to flashcard. There must be a substantive reason for the arrangement. Customers requested it. The product has been separately identified as belonging to the customer. It's ready for transfer, and I can't sell it to somebody else. If somebody else comes in and says, oh, looky, I saw, oh, that's beautiful. I want this thing. No, sorry, I'd have to put sold or something on that, right? Okay, so let's go ahead and we'll wait on that question. There's a question in the class questions that deal with that. Let's go ahead and continue on with the outline here, though. I'm not going to go through the book, bill, and hold arrangement here because it's so obvious. You'll see it in that question. And I don't want to waste time going through an example of something that you'll see how easy it is here in a couple of seconds. Consignment, what happens here? Let's say you pass the CPA exam, you write a book, and the book is titled Mothers Don't Let Your Children Grow Up to Be CPAs, okay? Now, you want to try to sell that book, but you go to Barnes & Noble or something, and they say, no, we're not going to buy that and hold that in our inventory. You get down on one knee and you say, please, please do this for me. They take pity on you and they say, we'll tell you what, you can go ahead and you can put the books on display for sale here at Barnes & Noble. If the books sell, then we'll keep 1% and we'll remit the rest to you, okay? Well, that would be a consignment arrangement. Now, when will you take the revenue?
When they sell.
When that is sold to a third party, right? You don't take the revenue because they've taken those from you. You have all the inventory risks, et cetera, associated with that, right? So consignment is when the dealer, Barnes & Noble, or distributor has not obtained control of the product. Revenue is recognized when the dealer or the distributor sells the product to the customer or when the dealer or distributor obtains control of that product. And then they give us indicators of consignment here. So that's what's going on with consignment. Now, warranties. The way to get, I'm not going to go through the example. The way to get warranties in your head is to think of what happens when you go to a company like Best Buy and you buy a computer, and they always do what? They always hit you up and they say, okay, well, it comes with a 1-year manufacturer warranty, but you can buy the extended warranty package with this, and that's going to cost you an extra $100, $200, whatever it is. Is that extended warranty a separate obligation, a separate product that they're selling you?
Yeah.
Is right. Okay. So we're going to have to account for that separately, right? Okay. So the accounting for the warranty will depend on whether the customer has the option to purchase the warranty separately. If it can be purchased separately, the warranty will be considered a distinct service because it is promised to the customer in addition to the product covered by the contract. An entity will therefore account for the warranty as a performance obligation, allocated portion of the overall transaction price to the obligation. If the warranty cannot be purchased separately, then there is no separate performance obligation. You buy the computer, they can charge you that for the computer. You're going to get that 1-year warranty. You're not going to say, well, don't give me the warranty and discount the price. It comes with the manufacturer, and they're going to automatically roll that into the overall price. Okay. Now, factors that should be considered to determine whether the warranty represents a service in addition, and you can flashcard this, although there's kind of like a funny way of looking at this, because sometimes they say, well, what would make it considered separate performance and what would make it considered a separate performance. So if law requires the warranty, then this would indicate it is not a separate performance obligation. the longer the coverage period, the higher the likelihood that it is a performance obligation, right? Extended an extra 2 years, whatever, okay? An entity must perform specific tasks to provide assurance regarding product compliance with an agreed upon specification. These tasks are likely not a performance obligation, okay? Now, you can come over and take a look, and if a warranty provides service to a customer that is beyond the assurance that the product will comply with the agreed upon specification, then the promised service will present a performance obligation and require the transaction price to be allocated. Okay, so all of these are basically sort of in and outs of when it will, when it won't. Okay, but again, the key thing for you to keep in mind is if it starts talking about additional coverage beyond the manufacturer, it has 1 year, but it's extended, those kind of words. They sometimes will say, oh, accident insurance. Okay, if you drop the computer, we'll cover it. That's obviously what something the manufacturer's not going to cover you if you break it. That's something that would go beyond damage, extension, that kind of thing. Those are the words you're looking for to determine if the warranty should be considered separate. Now you come over and refund liabilities and right to return. And remember, we said that in some instances, the repurchase agreement could be considered a right to return. Okay, and this is how we would account for those. And then even if it's not a repurchase, how you account for your estimate of returns. Okay, so an entity should recognize a refund liability if it receives or will receive consideration from a customer and anticipates having to refund a portion or all of the consideration. Okay, the refund is going to be a liability and represents an amount that the entity does not expect to be entitled to receive. Okay. Also, although we don't show you in this example, an asset related to the subsequent recovery of the product will also be recognized, because if it's a refund, they're also going to give you the product back, but they didn't mention that in this example on the sales return. Now, I'm not in love with the way they presented this, because I think it's a little bit, it's missing. Okay, because they say, well, we have these cash sales and we have a refund liability here of $5,000. So our sales revenue is $45,000. And that's not quite how it would be done. I'm not sure why they're showing it like that. Because what you would probably do is, yeah, you would debit the cash for $50,000. And you would credit the sales gross for $50,000. Okay. And then you would debit estimated sales return for, what is it, 5,000? And then credit that refund liability for 5,000. Okay. And then when you prepare your income statement, you'll have sales of how much? 50,000, right? What I credited there. You would have what? A less estimated return. You would treat that as a contra to sales of 5,000. That's that debit. And then you'd have what? Net sales of 45,000. Okay. And that's, to me, more realistic, because what a company is going to do, because if you just sat there and netted it out the way they did, then you wouldn't have this estimated sales return account. Okay. Because right now we have an account called estimated, the way I did it, we have an account called estimated sale returns of 5,000. And then what you would do is periodically, as you make sales, you'll look to see, well, these are my sales. What do I need in the estimated sales return? And you'd look to see what's in there, and you would adjust that account accordingly for what it is you think you need, because there's some sales that happen in year one, some sales happen in year two. And so you'd have to sit there and try to figure out, well, how much do I need based on the additional sales that I've made and the amount of sales that are potentially still outstanding. And so you need this information to be able to do this. It's almost like looking at an allowance for doubtful accounts and figuring out what you need to put into the allowance as you added on additional receivables. So I think this way that I'm showing you is actually, this is a little sloppy, in my opinion. Okay. Now, yeah, then if they actually return the stuff, yeah, then you would go ahead and debit the refund liability and credit the cash because you're giving them the cash back. That I do agree with. Okay.
Can I ask a question? The estimated sales return, that is an income statement account, right? And
it's a contra to sales. It's an income statement account. Most companies, when they prepare their income statement, just start you out with net sales. So they wouldn't necessarily show that on the face of the income statement, but it does, just like when you pick up, when you pick up when you look at financial statements in a textbook, they always say sales, less returns, less allowances, gives you less discounts, gives you net sales. But if you pick up Apple's financial reports, they're just going to start you with net sales, and probably somewhere in the footnotes, they'll show you how they got to net sales.
mm-hmm. So it's going to close every year.
No, it'll sit there. That's one that should sit there. Oh, I see what you're saying. Yeah, that's a good question. It's an income statement.
So the following year will just net the sales of the following year. So it's kind of a timing issue, right?
Yeah, that does complicate things a little bit here. Because what I'm saying is,
I think in your journal entry, it's the same thing. You will close that account, even though that they're showing it net. In your income statement, you will have the same effect. At the end of the year, you will close that account too. It's an estimate, right? So then next year, if your estimate was not good from the previous year, as we saw, it's a prospective adjustment. So it's basically you will have a higher estimate.
Yeah, but what happens if I have sales in the next year so I guess it's based on the current year's sales?
Yes, it's an estimate.
Mm-hmm. Yeah. But what do I do if I have amounts that could be returned in another year? I guess it doesn't matter because it's matched against this one.
Yeah, it's just timing. I mean, because it's just an estimate. You do an estimate of how much returns you're going to have. It's going to be, as you're saying, 10% or.
Yeah. So I guess, I see what you're saying. So I guess the thing would be analyzed as the refund liability. In other words, what more do I have to put in for any given year sales as a refund liability? Because it's an estimate. It's not like these people are all going to return the 5,000, right?
Right. So the liability is the only thing that's open.
Yeah. Okay. So I guess you could do it the way they're doing it. Yeah, not so much for the reason I gave a minute ago. I would still do it this way though, because I want to know what my estimate on my returns are going to be. And I guess I could get it through the refund liability account, but I'd like to have that information available. I mean, in accounting, you could keep track of anything you want. So I would do it this way, the way I'm showing you, but I see what you're saying. That ultimately, if you close that, then it doesn't matter.
Yeah, I
Still,
agree
you
with,
do it this way and you still have the same thing. That's a good point. And I guess you'd use the refund liability account as your way of estimating. You had additional sales. And so you've estimated that the amount that needs to be put in for any given year based on an analysis of the refund liability, and that would be your credit to refund liability, right?
yeah.
Okay. Okay. Yeah, that's a good point. Okay, good. Let's go ahead then and look at this JoJo Roasters question, which is dealing with the bill and hold, and see how that would be looked at. Okay, guys, I'm going to go ahead and end the poll here. It looks like most of us had a chance to try this one, and it looks like just about everybody got this right. The answer here is A, but let's just go ahead and let's take a look at this. Okay, and we have this company that is selling these coffee bean roasters. And they enter into an agreement to manufacture 5 roasters for the new production facility. The roasters were manufactured to the specifications, were completed on September 1st, year 2. Due to delays, the new facility is not available. And so they agreed to maintain the coffee roasters in a separate section of the warehouse until the facility opened on January 10th. SB paid for the roasters on October 1st, year 2. We can take the revenue and a bill and hold on year 1 because, September 1st, year 2, because we are doing what? We're simply holding that as accommodation. And it says we manufactured them to their specifications. So we're not going to be able to direct them to anybody else. So we've met the criteria for a bill and hold. Okay. Okay, good. Let's go ahead and let's take a look at long-term construction contract. This has been something that has been on the CPA exam for a long time, guys. And this was on the exam back when I took it, and I think that they are going to, continue to ask it. And it is an example, really, now, although it's been around for a long time, that fits under the formula of revenue over time And even though we don't call it out as such, we're using the input method here, okay? So we start out with percentage of completion. We're going to talk about completed contract in a minute. And the revenue is recognized over time, okay? Now, we are able to do this. We have to be reasonably able to estimate profitability and provide a reliable measure of progress towards completion. Now, how do we figure out using this input method? Okay, and income is recognized as a percentage of total estimated cost. And so it's the total estimated cost based on the most recent cost estimate to the total estimated cost. That's what's going to give us the percent done, cost to cost, okay? And there may be indicated by such other measure of progress towards completion appropriate the work performed. But for CPA exam questions, you could have engineering estimates and whatnot. But for CPA exam questions, it's going to be cost to cost. That's where we're going to have to focus, okay? Now you come over and we're going to talk about mostly the income statement here, but let's stop for a second and talk about balance sheet presentation, okay? And we are going to have current assets, okay? And the current assets will be based on billings, okay? So we'll have current assets, and one of our current assets here is going to be the amount due on account receivable. And that's going to be based on billings. We'll always have that. Now, we could have another current asset called cost of uncompleted contracts in excess of progressive billings. Or, okay, and this is where the or comes in, we could have what? We could have a current liability, and we'll have a liability in addition to that current asset due on account receivable if the progressive billings is in excess of the cost, okay? Now, let's just use some numbers to illustrate these. So let's say up here, my billings equal 900,000, and my costs equal $1 million. So I billed my customers for 900,000, but I've already incurred cost of $1 million. Okay. Under this situation, okay, we're right here now. Okay, we would have accounts receivable of 900,000. This is under our current assets section on our balance sheet. That says current assets, accounts receivable 900,000, and then we'd have costs in excess of billings. That says costs in excess of billings of what? 100,000. Okay, that's that situation right there. That's that green and blue. Okay, now coming down for the situation, the current liability, let's say the billings equal $1 million, but our costs are now only 900,000. So I kind of flipped it here. Okay, we'll still have this current asset accounts receivable of what? $1 million. But then, so that'll be our current asset. But then in our liability section, we'll have a current liability, and that current liability will be what? Billings in excess of costs. And that's going to be 100,000. Okay, so you always have the accounts receivable as a current asset, And then it toggles between what? A current asset, current liability, another current asset, or the current liability, depending on whether your billings are in excess of your cost or your costs are in excess of your billings. Okay. Now you come over and we give you the step method. Okay. And this is what you flashcard and use for the CPA exam. And guys, this is tried and true for answering all the percentage of completion contract, percentage of completion of construction contract questions on the CPA exam. Okay. So first thing, what's the profit? The question will give you the contract price. The question will give you the estimated total cost. That'll give you the gross profit. Then to figure out what percent done you are, you will take total cost to date divided by the total estimated cost of the contract. So if the total estimated cost of the contract is $1 million and you've spent $200,000 of your cost to date, what percent done are you? It's a question.
20%.
Good, 20%. If you have incurred $500,000 of cost and the total estimated cost is $1 million, you are 50% done, and so on, right? Okay, cost to cost. Then you want to figure out what is the profit you've earned to date. So you take the total gross profit times the percent done you are. That's how much you've earned to date. But if you want to figure out what the current period profit is, you take what? Whatever the profit is to date, that's that percentage done you are, but some of that work may have been done in a previous period. You simply subtract what you had in the profit to date for the beginning of the period, and what's left is what you've earned this period. Losses. Rule of conservatism says take losses immediately. I don't care if it's percentage of completion or completed contract method that we'll talk about later. You take the losses immediately. Rule of conservatism. Now, you come down, and this is a good example. This example has been in the Becker material forever. Okay, and it's a good example. I'm going to go through it with you here, but don't want you to mark up the example as I'm going to. As I go through it, I want you to just watch me. Don't mark up the example because it starts to look like a spider on crack here if you try to mark it up as I go along. So just watch, okay? So I go ahead, and this contract tells me I have a sales price of $4 million. It tells me the total estimated costs are $3 million. And the cost incurred to date by the end of year one are $1.5 million, okay? So what I do, don't mark it up, guys, just watch. So I take that total sales price. Total sales price is $4 million. The total estimated costs are $3 million. So the total estimated profit on this thing is $1 million. Now, what happens? The total estimated cost of the contract we saw already is $3 million, right? And so far, at the end of year one, I have incurred $1.5 million of costs. So I'm thinking I'm 50% done. I sit there and I say, well, okay, $1 million of profit is what I'm going to make on this contract. So far I've earned what? 500,000. This is year one of the contract. So there's no contract that's been recognized previously. So I say, okay, I earned all that this year. Now I go into year two, and this contract has some sort of fixed price on it, $4 million. I now estimate that my total costs are 3.2. So now I'm thinking my profit is only 80%. I'm 800,000. Guys, don't write this. Don't scribble all over this example. Okay. Now, if the costs incurred to date are 2,400, and I think my total costs are 32, then that 24 is how much work I've done. I think it's going to be a total cost, I guess I'm going to bring it from here, of 32. That means I'm thinking I'm 75% done. If I think my total profit is 800, times the 75%, that means I think the profit on this contract is going to be 600. That's the total. I already took what? 500 in year one. So this year I'm saying, well, I've only earned 100 of that. Okay. This is change in accounting estimate, guys. Remember, you don't go back and say, well, wait a minute, I took too much profit in year one. You just keep going forward with that new estimate. Notice, by the way, for completed contract, which we'll talk in more detail here in a couple of minutes, completed contract, you don't take any profit until you're done. Okay. Now what happens? Now I go into year 3, and I'm thinking this contract is going to cost me a total of 4.2. I've got a loss. I have to take that entire loss in year 3. So I don't care. I don't need to do this calculation up here because I need to take what? The entire loss. So I need to take that 200,000, but I need my retained earnings to reflect what? The total loss on this contract, which is 200,000, I'm estimating at this point. I have sitting in retained earnings, what? 600 of profit from the first 2 years. So to get my retained earnings caught up, I have to do what? I have to sit there and take what? An $800,000 loss this year. That does what? That eliminates the previously recognized profit of 600 and now catches up my retained earnings. So now there's a net loss in retained earnings of what? 200,000. And then when I finally get to year 3, I'm like, okay, I'm done with this thing. I'm going to lose 300,000 on it. I know now that I lost 300,000. Oh, completed contract, take the loss immediately. Losses are taken immediately under both methods. And then for percentage of completion, I know I've lost 300,000 on this. I already took 2, so I take 1 this year, and the same would be this case for the completed contract. Question?
So I have a quick question. So for year 1, if you calculated $500 of gross profit, then you won't take it next year. You will just subtract from the profit which you got in the current year from the prior year, if I'm getting it right.
Yes, that's correct.
Oh, okay.
Yeah. And the complication or the more interesting part of this is in year 3, once you determine you have a 200,000 loss, you have to take 8 to back out the previous 6 you've taken, 500 in year 1, 100 in year 2.
Okay, sounds clear. Thank you.
Yep. Okay. Now, under completed contract method, okay, balance sheet is same as percentage of completion. I don't have to go through anything more. They're same as percentage of completion. Okay. You come down and the profit on the contract is going to be the contract price minus the total cost, you think. I mean, that's very basic, right? And then you come down and again, losses are recognized in full in the year they're discovered. And that loss rule is the same for both methods. Okay. So now let's go ahead and let's take a look at a couple multiple choice questions. Okay. And I'm going to go ahead and turn you loose on this first one. Oops. I want to share results. I want to launch the poll. Okay, guys, we're at 2 minutes, 45 seconds. I'm gonna give you, I'll give you 3.5 minutes to work this question, but if you're on the CPA exam, you would be definitely wrapping this question up about now. And I'll give you an extra 30 seconds. Oh, no, I won't, because you're all done. So there's no sense in sitting here when everybody's finished this. So let's just go ahead and take a look at the results. And okay, good. We've got a good 80% that got this one right. This is a little tougher question. So let's go ahead and let's work with this one together. Okay. And so remember, the steps are what? First, we have to figure out what is the profit on this. Okay. Now, they tell me that the contract price is what? $3 million. So I'm just going to write that 3 million down here. Okay. And they tell me that what? My second step is to, well, I have to figure out the gross profit. So I have to figure out the cost. And they tell me that the cost incurred from year 1 to year 2 is 1.8. Cost estimated to complete at the end of year 2 is 600,000. So I think the total cost on the contract is what? Total cost on this contract is 2,400,000, isn't it? So if I have a contract that I'm going to get paid 3 million on, and I've incurred cost of what? 2,400,000. I'm thinking I'm going to make what? 600,000 on this thing, but I want to figure out, well, how much of the I earned on that? And they're asking me what? How much should I report on the income statement for year 2? So I'm going to look at that and say, well, look, I have cost incurred of 1.8. My total cost are what? 2,400,000. Bringing that down. So that means I'm thinking I'm what? 75% done. So I'm sitting here and I'm thinking, okay, I'm going to earn, I've earned so far on this contract, 75% of this, I've earned 450,000. And I think a couple people maybe picked A, but the thing tells me that what? I had already recognized, they're asking for year 2. In year 1, I already recognized 3. So I have to take that 300,000 that I've already recognized. And so in year 2, I'll take what? 150,000. I mean, that is classic how they ask that. That falls right into that flashcard that I asked you to make with the steps. Question. Okay, good. Let's go ahead then and let's take a look at this next class question. Okay, guys, looks like most of us have had a chance to work this one, and I don't want to delay any further to look at it because it's a pretty straightforward question. And so good 71, well, I would have thought more of us would have got this right. I would think we'd be more in the 90s, because they're telling us that what? There is a contract and we anticipate a what? A loss. And if we anticipate a loss, we take that loss immediately, both under completed contract and percentage of completion. So as soon as we take that loss, our what? Our net income will decrease in both cases, right? Our operating income will decrease. Thus, our net income will decrease. Take the loss immediately. Question on that one? I'm not sure why we didn't get 100% on it. Okay, good. Let's go ahead then and take a deep breath and jump us into chapter 2. Okay. Chapter 2 is kind of interesting in that it's sort of a catch-all hodgepodge of areas. I'm almost tempted to say, hey, look at chapter 2 on your own, because it's just sort of a conglomeration of low point value areas, and there's no real rhyme or reason as to exactly why these are here in terms of where we're going. I mean, we've looked at the income statement starting in chapter 3. We're going to really start heavily getting into the balance sheet. And so this is a bunch of stuff that they really didn't have any other place to put it, so they stuck it all here in chapter 2. Okay, so notes to financial statements, 2 points. Okay, subsequent events, 2 points. Fair value measurement, 2 points. Segment reporting, okay, maybe they would go as high as 5 points there. Okay, SEC reporting, 2 points. Special purpose framework, 10 points. This is the big area that we won't get to tonight. We'll get to this next time. Ratio analysis, I'm going to put 10 points, and I'll explain to you a little bit more about that here really before we get out tonight. Partnerships, and I don't know why there's been this rumor about that partnerships is no longer on the CPA exam. I don't know where that came from. The CPA exam will test you on partnerships, and we really won't get to that until next time. Okay, but I do want to spend some time, and I know we've been working hard here, guys, but I think we need to go ahead and invest in the time that we have left to see if we can knock out a couple of these light modules that are pretty easy, starting with notes to the financial statements. Okay, now the first note that you see in a set of financial statements is a summary of significant accounting policy. If you've looked at a set of financial statements in SEC filing, whatever, you've probably seen that that's probably the first footnote that you see. Okay, and the nature of things that go in here are things like measurement basis used in preparing the financial statements, or specific accounting principles, depreciation methods, inventory pricing. So it's really giving you what? A nice look at what measurements we've used and whatnot to put together the financial statements. Now, the remaining notes to the financial statements can cover a lot of different things. The point here being that you could see a CPA exam question which they'll ask you, which of the following should be considered a summary of significant accounting policy issue. They'll list things that we will be talking about in later chapters that need to be disclosed, but they are not considered, in fact, we'll talk about some tonight that need to be disclosed, but they are not considered a summary of significant accounting policy. So the key takeaway, summary of significant accounting policy is things like measurement methods, etc. Okay, okay, good. Now you come over and we talk about disclosure regarding risks and regarding uncertainties. Okay, now the key thing when we talk about uncertainty is the use of estimates. And you see in every set of financial statements, basically a warning that says there is uncertainty regarding estimate. We'll call that estimate uncertainty. Okay, that's what they're talking about there. When they talk about uncertainty, they're talking about estimates associated with uncertainty. We've seen that in the what? Completed contract or percentage of completion method. We were saying what our profit is this year, but there's a chance all that'll be taken away if the contract goes into a loss situation. Okay, so we warn that there's estimates, and the estimates may not come to fruition the way we're considering right now. Okay, now you come over, and when we talk about risks, because it's risks and uncertainties, what are the nature of risks? Okay, so you come down, and when we talk about risk, we're talking about vulnerability due to certain concentrations. That's the risk that we're really talking about here. And our disclosure requirements should disclose if all the following are met. When I see all, the next word out of my mouth is flashcards. There is a concentration at the financial statement date. The concentration makes the entity vulnerable, and that's in the near term. Okay, we don't have to look out 50 years in advance. And it is least reasonably possible that the event could cause the severe impact. Okay, and they start to give us examples of concentrations, for example, volume of business with a particular customer, concentration geographic area. You have a lot of investment in Russia, Ukraine, that would be a problem, right? Okay, and so that's the kind of thing that you'd want to disclose. Okay, all right, good. Let's take a look at question here. Put the poll up. Okay, guys, I'm going to go ahead and end the poll because I'm not sure this question should really take us 2 minutes, and I want to move into the next area. So I'm going to end the poll, and let's go ahead and take a look here. And yeah, most of us got this correct. The answer is C. When you start talking about criteria for determining cash and cash equivalents are short-term instruments that have an original maturity to the entity of 90 days or less. That's the kind of thing that you would expect to see in the summary of significant accounting policy. So most of us got that right. Okay. All right, good. Let's go ahead then and let's take a look at going concern. Okay. Now, here's what the examiners, oh, I'm sorry. No, not going concern. I guess that's out. Let's look at subsequent events. My bad. Subsequent events. Let's look at that. Okay. And when we look at subsequent events, okay, what we are looking at is two types of potential subsequent events. Okay. One is going to be recognized in the financial statements. Okay. By recognize, that means there will be a journal entry associated with that recognized and disclosure. So we'll literally make a journal entry and we'll disclose information about that subsequent event. A non-recognized subsequent event means that there will be disclosure only. There will be no journal entry associated with that, okay? So first, flashcard, the two types of subsequent events and what the result is. One has a journal entry plus disclosure, it's recognized. The non-recognized, there's no journal entry, but there will be disclosure, okay? Now, when we talk about a recognized subsequent events provide additional information about conditions that existed at the balance sheet date, okay? Entities must recognize those. In other words, there's going to be a journal entry associated with that. And they give examples of subsequent events that need to be recognized. For example, settlement of a litigation. So if a litigation arose before the balance sheet date and it is settled after the balance sheet date, but before the financial statements are issued. So the lawsuit started in November of year one. It's now year two. It's January of year two. We settle the lawsuit and we're not going to issue our financial statements until, say, February. Then we're going to have to make a journal entry and disclose what has happened because of that settlement of the litigation. So the journal entry will literally be to what? Debit loss, making a number up for $1 million. And credit a contingent liability for the $1 million. I'm writing $1 million in there because that's what should have been, would have been booked had we known what the outcome of this situation was that existed at the balance sheet date. So we literally sit there and debit loss, we make a journal entry, credit contingent liability. Yeah, okay. Now, we reported, there it is, report a liability and a loss on the balance sheet. Okay, now you come over and they say loss on a collectible receivable. And they say the effects of a customer's bankruptcy filing after the balance sheet date, but before the date of the financial statements are issued, would be considered when determining the amount of uncollectible receivable to be recognized in the financial statements. So we're literally going to have to make a journal entry, even though the customer didn't declare bankruptcy until after the year end. Now you look at that and say, well, wait a minute. Why would we have to take a loss if they don't declare the bankruptcy until after year end? Well, the accounting standards specifically say bankruptcy doesn't happen overnight. The events and circumstances that led to that bankruptcy filing in year two were already in effect in year one. So you should go ahead and book a loss, make a journal entry, and of course, and disclose. So here we would do what? We would debit the allowance for doubtful accounts. And I'm just going to make a number up here, $500, whatever. And we would credit the account receivable, right? To write that off, $500K, whatever it is, okay? When you debit the allowance account, does the amount in the allowance go up or down?
Down.
Good. The amount in the allowance account goes down. So now I'm looking and saying, uh-oh, the allowance has gone down. I probably need a little more in the allowance now, right? Because I took some out that I hadn't anticipated that I would before. So I would probably go ahead and do what? Debit bad debt expense. I don't know, for another whatever I determined I need at that point, say $300. I'm just making that up. And credit what? Credit the allowance?
Yeah.
Whatever the additional amount is. The takeaway here is not that part so much as what? Journal entries. A series of journal entries for what? for a loss on the uncollectible receivable, even though the client didn't declare bankruptcy until after year end. Why don't you flashcard that? Because that's a little tricky. Okay, now if it's a non-recognized subsequent event, that means we will not have to put an entry. So the entity should not recognize subsequent events that provide information about conditions that did not exist at the balance sheet date. For example, loss of a plant because of some sort of disaster or something. The plant burns down in January. Well, it was still there December 31st, but that's a pretty significant thing. So we would do what? We would disclose that in the year one financial statements. There would be footnote disclosures to that. Okay, so the following subsequent events occurring after the balance sheet date, but before the date the statements are issued, are considered to be non-recognized subsequent events, but we do what? But disclose. Okay. Okay, good. So you could go ahead and flashcard that, and maybe you want to flashcard that specific example. It doesn't have to be. Okay, and they tell us again that non-set recognized subsequent events should be disclosed. So no journal entry, but they have to be disclosed. You'd still see that plant that blew up or whatever as part of my property, plant, equipment, but now it's not there anymore, right? Because it blew up. I'd still leave it in my fixed assets, but I would have to disclose that there's a hole in the ground where that plant used to be. Okay, now you come over and subsequent event evaluation period, and they say that entities that file financial statements with the SEC must evaluate subsequent events through the date the financial statements are issued. Okay, so they have to keep looking to see if something should be booked or disclosed all the way to the time that the financial statements are issued. All other entities must evaluate subsequent event through the date the financial statements are available to be issued. Flashcard that, and then they tell us here that financial statements are considered available to be issued when they're in the form of format that complies with GAAP. Okay, I don't know that you need to flashcard that. If we have to reissue financial statements, we do not have to evaluate subsequent events that might have occurred between the original date the statements were issued and the date the statements were reissued. Okay, otherwise you'd be sitting there and you'd have a nightmare on your hands trying to figure out every subsequent event that should have gone into a set of reissued statements. No, you don't have to do that. Okay. Okay, good. We don't need this detailed example. This is way overkill. I think we've got the key understanding here. So let's just look at this question. And I'm trying to get the poll, but our friends at Zoom are playing hide and seek with my cursor. Okay, stop, guys. C is never right for subsequent event now. Come on now. Both had what? Disclosure requirements. Both had disclosure requirements. So don't pick C. I'm going to give you 5 more seconds on this. Okay, I'm going to go ahead and end the poll because this makes no sense in spending any more time with this question than that. Okay, so not everybody got a chance to answer this. 77%, I was thinking we should be getting 100% on this and quickly. Okay, some of these questions you got to be prepared to answer them pretty quickly, although right now I'd rather have accuracy than speed. So shut up, John. Okay. So right now we have this ACE company settlement litigation on February 1st, year 2, for an event that occurred during year 1. Well, this is the specific example of a situation where we had a lawsuit that was out there in year 1 and was settled in year 2. Okay. And an estimated liability was determined at December 31st, year 1. This estimate was significantly less than the final settlement. Okay, so we had set up an estimate of the loss, but now it was different than the final settlement. The transaction is considered to be material. Financial statements of the year have not been issued. How should the settlement be reported? And it's going to be what? It's going to be both disclosure and accrual. So in other words, if in the estimate before at December 31st, I had gone ahead and debited what? Debited loss on this lawsuit for $1 million and credited contingent liability for $1 million. And then as the problem indicated, you know, a little bit later, you know, in January, or the telling in February, before the financial statements were issued, I found out, oh, the person settled for $500,000. What would I do? I'd have to debit contingent. Say they settled for $300,000. I'd have to debit contingent liability for $700,000 and credit what? Credit the loss for $700,000. So now net the contingent liability showing 3 and the loss is showing 3, which is what I settled for. And I would have to always disclose. Anything that says there should not be a disclosure is wrong for something like this. You have to disclose both non-recognized and recognized. This would be recognized and would be handled like this. Question?
I have a question. So if, let's say you have this customer and he didn't like the product, so then you have the sale, you have the cash at the end of year 1, and you recognize the revenue and everything. And then you are preparing the financial statements, but you get the lawsuit in year 2.
You get the what? Lawsuit?
Yeah, that you receive the lawsuit in the notification of the lawsuit in year 2.
That would be a non-recognized subsequent event that would be disclosed because the lawsuit won't come until year 2. Yeah.
Okay.
Yeah. Okay. I am not going to start module 3 because we'd be just trying to jam it down our throats here, and I'm not going to do that. Okay. So we're going to pick up module 3, chapter 2 next time. I'm hoping that we can get through chapter 2. I know we're behind, but we'll just keep chasing that beast as we go through. This is not uncommon as we go through and do a thorough job understanding the material here. Okay. Any question? Okay. I know Roy had asked for a little bit of time, but I'm going to go ahead and end the recording at this time, and I'll get these posted up. And Roy, you can hang on here and we can have a little conversation here after.